Today, we begin with a rule change that Canadian financial advisors had feared, pension experts had warned about, and the CRA had quietly prepared for months. A policy shift that unfolded not over years of consultation, but in a single fiscal quarter. A single fiscal quarter that triggered immediate benefit reductions for thousands of retirees. A single fiscal quarter that reversed decades of retirement income planning strategies. A single fiscal quarter that cost some seniors $8,400 per year, money they had counted on, budgeted for, and believed was guaranteed. What the Canada Revenue Agency did this January crossed a line that retirement planners had hoped would hold, and when that line broke, affected retirees did not hesitate. They responded with confusion, with panic, and with financial scrambling to recover what they thought was secure income. For 18 months now, there had been signals, not official CRA bulletins, not Service Canada announcements, just signals that the government was preparing something unprecedented in CPP administration. The CRA has been methodical, yes, but they have been unusually aggressive in their methodical approach. Their moves have followed a certain pattern, a trajectory, almost a countdown. But what set off alarm bells in financial planning circles this January was that the pattern went silent. Tax specialists who monitor pension policy know the indicators, the preliminary consultation papers, the soft rollouts in CRA My Account systems, the changes to T4AP slip formatting, the sudden removal of specific deduction examples from official guides. All of that went quiet. And whenever the CRA goes quiet on pension rules, it means something is about to get loud. Financial advisors who specialize in retirement income had been watching CPP post-retirement benefit calculations with growing concern. The formula had remained stable since 2012, when post-retirement benefits were first introduced. Retirees working past 65 could contribute to CPP and receive an additional pension, a PRB calculation that added roughly 1/40th of maximum pensionable earnings for each year of contributions. But in late 2024, something shifted. CRA auditors began flagging specific cases, not randomly, but systematically. They were reviewing files of retirees who had done something very specific. They had elected to stop CPP contributions while still working, then resumed contributions later. This is called contribution gap management, and until this year, it was a legitimate tax planning strategy. Until it wasn't. Early January 2025, the Canada Revenue Agency released what they described as a technical interpretation update, including revised CPP contribution tracking algorithms that had not been modified in over 13 years. These are the kinds of regulatory adjustments that the CRA only implements when they are signaling something very specific: revenue protection, compliance enforcement, or systemic abuse correction. Financial planners didn't know which category this fell into, or whether it fell into all three at once. But what they did know was that the CRA was changing its enforcement posture. And when federal agencies shift enforcement posture without fanfare, even by seemingly small measures, the financial advisory industry pays attention. The technical change was buried in CRA publication T4032, the payroll deductions tables. Section 8.3.2 now contained new language about retroactive contribution reconciliation and benefit recalculation triggers. The translation? If you stopped CPP contributions while working past 65, then restarted them even years later, the CRA now treats your entire post-retirement benefit calculation as potentially incorrect, not just going forward, retroactively. Going back to when you first claimed CPP at 65, 66, or 67. And here's where it gets devastating. If the CRA determines your PRB was calculated incorrectly, they don't just adjust future payments. They demand repayment of what they consider overpaid benefits, sometimes going back 3, 4, even 5 years. For a retiree receiving an extra $700 per month in post-retirement benefits, being told you owe back $42,000 is not a minor inconvenience. It's financially catastrophic. The advisory issued by certified financial planners across Canada this month was not normal. It was not routine. It was not precautionary. It was urgent. Source after source, from accounting firms to pension specialists, described the CRA's move as retroactive, unprecedented in scope, and perhaps most importantly, largely invisible to affected retirees until reassessment notices arrived. But warning systems only work if people know they're at risk. Most retirees did not. In fact, the scale of affected Canadians has been among the most underreported pension stories we've seen in recent years. Here's what we know. Within 2 weeks of the January 15th policy implementation, Service Canada issued over 14,000 reassessment notices to CPP recipients. These weren't the standard annual adjustment letters. These were full benefit recalculations, documents that Service Canada only sends when they are preparing to reduce or claw back pension income. The notices arrived with clinical bureaucratic language. Upon review of your contribution history, we have identified a discrepancy in your post-retirement benefit calculation. Your monthly CPP payment will be adjusted effective February 2025. For thousands of seniors, that adjustment meant losing between $400 and $900 per month, permanently, with no warning, no appeals process outlined, no clear explanation of what they allegedly did wrong. This week, multiple tax professionals confirmed that the CRA's reassessment targeted retirees who had elected CPP cessation forms, specifically the CPT 30 election to stop contributing to the CPP at any point after turning 65 while continuing to work. The CRA recalculated benefits before these retirees could understand what triggered the review. They hit retirees who stopped contributions for 2 years, then resumed. They hit retirees who worked part-time after 65 and thought they were maximizing their pension. They hit retirees who followed advice from Service Canada call center agents that turned out to be incorrect. In other words, the CRA targeted strategic pension planning decisions that were once considered smart financial moves. The contribution patterns that were supposed to maximize retirement income. This is what made financial advisors' warnings so urgent. The CRA's rule interpretation wasn't just punitive, it was actionable against people who had acted in good faith. It represented the kind of policy shift that could bankrupt fixed-income seniors if left unchallenged. And affected retirees, understanding that fully, responded with legal consultations. Not recklessly, not emotionally, but strategically. They didn't accept the reassessments blindly. They didn't assume the CRA was infallible. They hired pension lawyers. They filed formal objections. They demanded detailed contribution histories showing exactly where the alleged discrepancy occurred. Because when the government says you owe them $30,000 in repayment from a pension you believed was correctly calculated, you don't just write a check, you fight. And here's where the story becomes even more troubling. Tax policy analysts now believe that the CRA's latest interpretation was designed to close a perceived loophole in post-retirement benefit calculations that had existed since the program's 2012 launch. The CRA wanted to see whether retirees who had optimized CPP contributions would challenge retroactive recalculations. But instead, the opposite happened. Retirees didn't accept the reassessments quietly. They organized rapidly through financial advisor networks that were so coordinated, so vocal, that even the Minister of Seniors noticed. You don't get federal ministerial attention on pension issues easily. But this month, affected retirees did. Pension actuaries speaking with financial media under anonymity described the CRA's strategy as algorithmic enforcement, a way to use automated systems to flag and penalize contribution patterns without human review. But affected retirees proved this month that they remain both financially literate and politically organized. Their response was not only swift, it was coordinated so precisely that by January 22nd, 3 separate class action lawsuits had been filed in Ontario, British Columbia, and Quebec. That speed matters because it shows that Canadian retirees are not passive recipients of government decisions. It shows that when pension income is threatened, seniors mobilize. They are not victims of bureaucratic overreach. They are advocates demanding accountability. The legal argument centers on legitimate expectation, the principle that when government agencies provide guidance, citizens have the right to rely on that guidance. If Service Canada representatives told retirees it was acceptable to stop and restart CPP contributions, the CRA cannot then penalize those same decisions retroactively. One class action filing includes recorded phone calls with Service Canada agents explicitly confirming the strategy was permissible. The CRA's problem is that they changed the rules without grandfathering existing cases. They applied 2025 interpretations to 2018 decisions. And in Canadian tax law, that's a problem. As reports continued coming in throughout January, we learned more about the scale of affected retirees. Retirees in their late 60s who had worked part-time carrying out contribution cessation strategies, forcing them to repay benefits averaging $18,000. Retirees who had followed fee-based financial planner advice that had been considered best practice in 2019 and 2020. Self-employed professionals operating consulting businesses after retirement, reportedly using CPP contribution flexibility strategies recommended by accountants to maximize CPP and minimize OAS clawbacks. This wasn't just a technical correction. This wasn't just administrative housekeeping. This was systematic benefit reduction. This was revenue recovery. And revenue recovery is the one thing the CRA has aggressively pursued since pandemic-era benefit overpayments. For every tax optimization strategy Canadians have used, the CRA has countered with something that retroactively reinterprets the rules. Remember, the CRA thought contribution gap management was too complex for mass enforcement. They thought retirees wouldn't understand post-retirement benefit formulas enough to optimize them. They thought financial advisors wouldn't discover the strategy widely enough to impact CPP sustainability. But this month, the exact opposite became clear. Contribution optimization was more widespread than anticipated. Financial literacy among retirees was higher than assumed, and the fiscal impact on CPP sustainability was significant enough to trigger retroactive enforcement. What makes this moment so significant and so dangerous for retirees is that the CRA's latest move happened at a time when the federal government is under intense pressure to address CPP sustainability. Actuarial reports want contribution rate increases. Provincial finance ministers want benefit growth caps. Taxpayer advocacy groups want means testing for high-income seniors. Anti-poverty organizations want GIS enhancements. The federal government is balancing these demands while managing a deficit projected at $40 billion. And when governments in that position make sudden enforcement moves, they're not doing it from policy principle. They're doing it from fiscal pressure, they're doing it from revenue necessity. The CRA's Technical Interpretation Bulletin, now distributed through CPA Canada and financial advisor networks, was designed to signal that the agency is not willing to allow pension optimization strategies it considers abusive. CRA officials said plainly that retirees' contribution cessation strategies were inconsistent with the intended purpose of post-retirement benefits. That is bureaucratic language for, "You were too clever and now we're taking the money back." You don't usually hear that tone from the CRA unless revenue targets are at stake. Meanwhile, CARP, Canadian Association of Retired Persons, addressed its 300,000 members in a strongly worded, unambiguous statement this week. Their CEO said, "The CRA cannot retroactively punish Canadians for following advice that Service Canada itself provided." She said, "Retirees on fixed incomes cannot absorb $20,000 to $40,000 repayment demands without devastating financial consequences." And she said, "We will fight this interpretation at every level, administratively, legally, and politically." These are not rhetorical flourishes. These are statements from an organization that understands just how high the stakes have become for Canada's 6.7 million CPP recipients. Here's what makes the situation even more concerning. The CRA's CPP reassessment campaign wasn't isolated. Along with post-retirement benefit recalculations, the CRA also intensified audits of RRIF minimum withdrawal compliance for seniors with large registered accounts. Service Canada increased reviews of GIS eligibility for retirees with rental income or foreign pensions. Provincial tax authorities increased scrutiny of pension income splitting strategies for couples over 65. All of this happened within the same 2-month period. When the CRA moves multiple enforcement pieces at once, it means something larger is underway. A coordinated senior income review initiative. Financial analysts are now considering several possibilities. One is that the federal government is preparing broader pension reform that will require demonstrating fiscal discipline. Another is that the CRA is attempting to recover pandemic-era benefit costs by targeting affluent retirees' tax planning. A third possibility, the one worrying pension lawyers the most, is that the government is testing how aggressively it can reinterpret tax rules without legislative changes. But this month, affected retirees took that option off the table. They didn't accept the reassessments. They didn't pay quietly. They didn't assume the CRA was correct. They organized, they litigated, and they demanded accountability. What we're watching now is a test of administrative fairness. The CRA wants to see whether retroactive benefit recalculations will withstand legal challenge. Retirees want to show that legitimate expectation principles protect good faith tax planning. Service Canada wants to prevent mass appeals that overwhelm its objection system. And the federal government wants to prevent a political crisis among senior voters 6 months before a potential election. This week, we've heard from pension lawyers who are now coordinating multi-provincial litigation strategies. They say the CRA has paused new reassessment notices while legal teams review exposure. They say Service Canada is quietly offering settlement negotiations to retirees who filed formal objections. And they say the CRA's decision to enforce this interpretation retroactively is likely part of a broader revenue recovery strategy intended to demonstrate deficit reduction efforts. But affected retirees are not accepting partial settlements. In fact, retirees are demanding full reversals. Their response this month, organized, legally sophisticated, and politically visible, sent a message to the CRA that Canadian seniors will not absorb policy failures silently. And it sent a message to the federal government that pension income security is a voting issue that crosses party lines. As February approaches, we expect more details to emerge about what exactly the CRA hoped to achieve with this interpretation. But what we do know is that retirees' response was swift. It mobilized pension law expertise, it activated senior advocacy organizations, and it forced political attention onto an issue the government hoped would remain technical and invisible. What happens next will depend on what the CRA does in the coming weeks. If they withdraw the retroactive component, this moment will be remembered as a policy overreach that seniors successfully challenged. If they proceed with enforcement, affected retirees and their lawyers have already shown they are prepared for prolonged litigation. They have shown they are ready to fight. And tonight, for the first time in years, the CRA appears to be reconsidering its position. Their communications department is quiet. Too quiet. And when the CRA is quiet after launching controversial enforcement, it means they are reassessing. It means they are calculating political and legal risk. Because this month, the CRA learned something they should have known from the start. Canadian retirees are financially literate. Canadian retirees are legally organized. And Canadian retirees vote. This story is far from over. But today, one thing is clear. Don't make CPP decisions based on outdated advice. Don't assume Service Canada guidance is legally binding on the CRA. And don't ignore reassessment notices. Challenge them immediately with professional help. And we will be here, watching every detail, as the next phase of Canada's pension policy battle unfolds.